Hello, everybody. It's John Llodra and Michelle Moss here for our New Harbor weekly client update video. Great to be with you again here today. We're going to keep it short and sweet as we always try to do. I guess I'll just make a couple of quick comments on the markets and then some recent actions. And Michelle's going to talk about some flexibility that we build into client portfolios and really cater it towards their unique situations. And we'll cover that hopefully in 10 to 15 minutes, that kind of thing. Before we get going, though, I want to give an announcement here that we're going to have a live Q&A session for our clients on Tuesday, the 8th of August at 2 p.m. Eastern. Regina from our team sent out an announcement and a sign up for that via email. Hopefully you got that. We would love for you to join us, or at least reserve your spot, and at the very least we can send you a recording afterwards. But it's really an opportunity for our clients to be live with us together. They can be anonymous if they would like, and to submit questions to us in advance so that we can have some complete and suitable answers for the questions that you might have. So please look out for that email if you haven't seen it, and do call our office if you don't see that, and we'll happily get you on the list. So thank you. So just quickly, so here we are. It's Wednesday, the 2nd of August. A little bit of a down day in markets today, and the notable action in markets over the last handful of days has really been in the bond markets. A few kind of newsworthy events have really kind of rattled a little bit the bond markets, which of course has spilled over into most other asset classes. Basically, last week, the first kind of ripple in the bond markets was caused by the Japanese central bank basically making an announcement that they were going to kind of make some tweaks. I'll use that in air quotes, tweaks to what they have labeled their yield curve control policy. And this, I don't want to get too deep in technical jumbo here with you, but basically it's they're trying to control the yields on Japanese bonds, Japanese government bonds, from shooting too high. They've been engaging in a tremendous amount of liquidity provisions over the last bunch of years, like our central bank has done, and the fear was that yields were going to rise abruptly. So they've intervened in their bond market to put a cap essentially on yields. Well, the bottom line is they've announced that they're going to be more flexible. They had capped that yield on Japanese government bonds at 0.5%. They're going to let it float up to say 1%. So that had a little bit of a reaction, and caused treasury bonds in the U.S. here to sell off a little bit and yields to spike. Just on the heels of that, the U.S. Treasury announced a forecast of the amount of debt issuance that they're going to need to issue to fund deficits and the ongoing operations of our country. And it came in at about $1 trillion for the quarter, about $250 billion more than was originally planned or announced. So kind of shocked the market a little bit in terms of, wow, we really are in that kind of fiscal situation where we're going to have surprise announcements like that. And that certainly didn't help the bond market. And then just within the last 24 hours, one of the major rating services, credit rating services, Fitch and Company, downgraded the U.S. creditworthiness, United States creditworthiness, from AAA, the highest level, to I think AA+. Honestly, I think that's more of a symbolic thing. I wouldn't read too much into it, because it's not news to anybody, certainly not to us, that here in the U.S. We have got a pretty precarious fiscal path, and the extrapolation of the current path is not a good outcome. So, but all to say that both bonds and stock markets are greeting this soup together with some weakness here today. And this is a perfect example where the hedges we have put in place on some of the longer term bond holdings that we've held as a tactical shorter term trade are really kicking in. They're doing exactly what we intend them to do, and frankly, we're at the point now where the hedges are very robust, that any further weakness in those bonds, if interest rates were to continue to rise, would be significantly offset, because we have about half the position hedged. So happy to answer any questions folks might have on that. But One of the keys of our style of management is flexibility and nimbleness, especially in a market that we anticipate will become more volatile as some of these things start to play out. And that is, we incorporate flexibility and nimbleness on a portfolio level, but there's also really a client-specific degree of flexibility and nimbleness that we try to build in. And this really gets back to each client's own situation and their timelines, expenditures, needs for liquidity and things like that. So Michelle's going to cover some of the common considerations that we talk about with clients and build into their financial plan. So I'll hand it over to Michelle to take that part of the conversation.
Hello. So when we think about liquidity, we've been talking a lot about liquidity in the markets, but there's also your personal liquidity. And that's to determine how much money should you not invest? How much do you want to shield from market volatility so you have what you need for your expenses and for your goals that you expect to fund in the next year or so? So it's helpful to get sort of some targets so that you kind of know how much cash to keep at the bank and how much to keep in other places. So first of all, let's talk about the emergency fund. So that's your buffer to cover any unexpected expenses. They could be medical expenses, car expenses, gaps in employment, all of that stuff. You want to make sure that you have about 3 to 6 months of expenses in a very easily accessible bank account so that you can push a button and have the money if you needed it. But for other big purchases and goals, if you're saving for a house or a car or a big vacation, that might be something that has a little bit longer of a timeline, maybe about 6 months to a year. And for that, you can consider a high yield savings account or a money market or T-bills, something to earn slightly higher interest. And it may not be accessible in a click of a button like cash in your bank account, but very easy to turn around into cash when you need it if you have a couple of days. So, and we do this for our clients all the time. Sometimes clients are saving for a house down payment. And so that's why we have a T-bill only model, just rolling short-term T-bills to keep everything liquid and safe and earning some interest. And then there's also cash that you might want to have on hand because sometimes things happen like power outages and weather events. So it's helpful to have a couple $1,000 somewhere safe in your house, maybe in a safe or something. And then precious metals we talk about from time to time. That's kind of the ultimate wealth insurance. So we recommend 5 to 10% of your liquid investable assets in precious metals.
Great. Well, great. Thank you, Michelle. And of course, these details are conversations that are best had with individual clients. We invite these conversations with you anytime. We have them every day of the week with many of our clients, and just happy to have those personalized conversations with you. Just a quick note, hopefully most, if not all of you are aware that the full integration of TD Ameritrade and the Schwab merger is going to be culminated on Labor Day weekend, where basically TD Ameritrade name will cease to exist and it'll all be umbrellaed under the single company Schwab. And we anticipate that things are going to be very smooth there. We've seen on our end of the equation, the advisor tools that we have. Absolutely, what is coming through is the pledge that they made that we're going to try to take the best of both companies and put that into the hands of our clients, which are us, the institutional advisors, but also you, ultimately the client whose assets are safe kept there. So we are hopeful that it will be very seamless transition, and very confident it will be. We're not naive enough to think that there won't be a couple hiccups here or there or some questions, and that's why we're here to serve you, and don't ever hesitate to reach out to us. But we're going to be putting out a video specifically on that within the next week or so, probably. Most likely Christine Driscoll, who many of you of course know, is our head of operations and compliance. But we'll make sure you're plenty prepared and plenty informed about what to expect there. But we're excited to have this transition complete, because ultimately we think it's just going to enable us to do our jobs better for you, and we're hopeful that you'll find the user experience from your side even just a little bit better, and that's all we can hope for. Again, want to remind folks of the Q&A on August 8th. That's Tuesday, August 8th at 2 p.m. Eastern. Please sign up, register via the email that Regina sent out. And until now, we just want to keep this real short and sweet, and we'll be back certainly next week with some more video communications, and we hope to see many of you at the live Q&A. Thank you all. Have a great day, and we'll see you soon.